Hello, Darren Hamilton with Denman Hamilton and Associates. And to my left here is my partner, Neil Denman. So today we're going to talk about the second half of our balance sheet review. We had a great conversation last time, Neil, on assets. And one of the big takeaways I took from, it was two takeaways. One was the importance of having quality information in your balance sheet.
Garbage in, garbage out.
Garbage in,
right?
Garbage out. I agree 150%.
Got to get that right.
The second thing that I got from it was the importance of the owner using the balance sheet to manage the business. But the thing I liked the most about last podcast was the importance of that ratio. And what was the name of that ratio we talked about last time?
The current ratio.
That would be the current ratio. And so after today, you'll understand the other side of the current ratio so that you can understand both sides of that equation. All right, Neil, let's take it away.
So last time we talked about the assets in the business. That's the stuff the business owns. Cash, accounts receivables, equipment, cars, trucks, whatever it might be. Today, we're talking about the opposite. It's what the business owes to other people.
Yes.
Those are what are called liabilities. Liabilities are what you owe someone else, whether it is a vendor, the bank, the utility company, a federal or state taxing authority. Liabilities are what you owe. And, you know, most people want to try and minimize what they owe to people.
I agree.
You know, because when you owe money to people, you know, they get to dictate the terms. You know, if you owe the bank money, they say you've got to do this every quarter. Maybe you've got to provide quarterly financial statements to us.
I agree.
Maybe they say you've got to go get your property appraised every 3 years, and that costs money. So liabilities are what you owe, and we want to try and find ways to help minimize that to the best of our abilities. Liabilities are broken into two parts. One are what are called current liabilities. Current liabilities are things that you're going to have to pay in less than a year.
Yes.
You know, a year seems like a long time, but a year can really sneak up on you. Because one of the things when you're dealing with the banks, and construction contractors in particular get hit by this every year, they have a lot of equipment, so they owe banks a lot of money. Any type of long-term note payment to a bank that has to be paid within the next year is considered a current liability. So current liabilities, you have to pay them within a year. Long-term liabilities are things that are more than a year. This might be if you have a building that you've bought and you're making payments over maybe 20 years.
Yes.
You know, the payments that are come after this year are considered long-term liabilities.
Yeah, I think the big thing about that is a lot of times if you do not manage your balance sheet, you can start accumulating debt. And the more debt that you accumulate, it's going to start impacting your cash flow.
Right, because a lot of times you'll see people that get in trouble where they've got a lot of short-term debt coming due and don't have enough short-term assets to take care of it, is they go borrow on a line of credit and just create themselves more debt, more debt, more debt. And it kind of becomes a never-ending cycle sometimes.
It does. It does. And once you start that process, it's going to take extreme discipline, and it's going to take a process of evaluating your financial statements to where you can eventually get out of that hole. So being able to understand that is very, very important.
So as you're looking at the liabilities on there, and we talked about this in the podcast previously on the assets, if you're seeing negative liabilities on your financial statements, you've got a problem. We see it all the time. One of the biggest mistakes that we see are when payments are made on liabilities is the principal and interest isn't broken out because you're paying money on this long-term debt. You're paying interest on it, I mean. So if you've got a $1,000 payment, maybe only $400 is going towards the principal on this. So, but the business owner may be applying the full $1,000 to the loan. So the loan on their balance sheet is getting reduced fast, and it looks great. But at the end of the
reality, there you go.
You still owe the money because you didn't record it right. Or the debt never made it to the balance sheet. Or every payment that you're making on it doesn't reduce the debt in your balance sheet because you think it's an expense, right? Loan payments on debt to the bank, to Ford Motor Credit, to GMAC, to Citibank, Bank of America, those actual payments are not expenses. They're a reduction of debt.
And that's the number one thing that we see out here. So you've got to make that distinction. So when that Toyota financial payment comes through there, $752.28 every month, to Neil's point, I see it so many times. That is not an automobile expense.
That's a debt payment.
It's a debt payment, and it's going to impact your ratios as far as your debt, as far as your debt to assets. So that is a big part of what we see. Now, the last part of this balance sheet is the equity section. The equity section doesn't get a lot of love, but to me, the equity section is extremely important. So, for example, if I have $100,000 in assets and my liabilities are $80,000, Neil, what would be my equity, which means my stake in the company at that time?
Right. This is the fundamental accounting equation. Assets minus liabilities equal equity. So if you've got $100,000 in assets, $80,000 in liabilities, your equity's $20,000.
Equity's $20,000. And so that becomes important because it allows you to see your value or your stake in the company.
So it lets you see your hard work over the years.
Yeah. So if I have $100,000 in assets and $225,000 in liabilities,
which we see, you see stuff like that. You do.
For sure. What does my equity position look like?
So you've got a negative equity position in that case. You're negative $125,000. 100 minus the 225 is a negative 125. What that's telling you, if you were to liquidate your business today, you couldn't pay your debts.
You would be in a deficit position. And that's also telling me something about how you manage your business, because I don't want to have a negative equity position. And as a business owner, that's going to impact your ability to do things, to expand, to grow, and to make a difference in the business.
And I think something that's important here to point out, your accounting equity position doesn't necessarily mean this is what your business is worth if you went to sell it.
True, because there's a lot that goes into that.
So keep that in mind. Those can be different.
Yes.
And often are. But keep that in mind. But to tie those two things together, if you've got a negative equity position and you've got a prospective buyer coming to look at it, why are they going to buy something that's upside down? Have you mismanaged the business, or is something else really wrong and the business model just doesn't work?
Very true.
So you want to be seeing these positive equity situations. Another thing that will cause a negative equity situation is when a business owner doesn't have a good business budget or a good personal budget in place. So what they're doing is they are pulling every penny they can out of the business. And a lot of times they're going and getting business loans in order for them to pull money out to personally live off of. A situation like that creates a negative equity situation.
Creates negative equity. It creates cash flow issues. It creates financial pressure. And it creates impacts on the longevity of the business. So I think that's a perfect segue into our next podcast. Our next podcast is going to be awesome. We're going to be talking about what Neil just mentioned. We're going to be talking about budgeting. And to me, budgeting is the lifeline of a business. There's so much that can be done when you have an effective team, a business owner, a financial advisor, all working together for the common good of a business. It can make things happen. So until next time, Darren Hamilton with Denman Hamilton and Associates.
And this is Neil Denman, asking you to let any of your friends or family know that want to learn more about how to effectively manage their businesses by understanding their balance sheet. Have them give us a call. Our number in Little Rock is 501-312-9491. And we'll see you next time for our budgeting podcast.